Hello and welcome to the Durham Talents channel. My name is Jesse Durham. For today's installation in our Myths, Mysteries, and Misconceptions playlist, we're going to address IUL, Indexed Universal Life. I'm going to have Jdew from the Cash Compound, one of the banking bros, come in on this conversation with me, share his insights. Of course, we're having lots of conversations with folks that are hearing and seeing lots of information about IULs, but going hand in hand with implementing infinite banking. So we had a great conversation, and I hope you enjoy. All right, Jdew, I knew that I wanted to have this conversation, and I've partly been putting it off before sharing with the people, other than making general comments about, well, just go to Nash's book and see what he says about universal life.
Okay.
But nowadays, people are talking to us all the time about index universal life. And that's not to say that there aren't other universal life conversations that come to us, because depending on the generation of folks that we're talking to, they're already telling us, well, yeah, I got a universal policy back from the 90s, and now I'm dealing with these health issues is a lot of the times the direction that the conversation also goes. But in general, I've normally just pointed people towards that chapter in Nash's Becoming Your Own Banker book, where he says he didn't own them, he didn't write them. That's been my personal trajectory as well. I don't own any, I don't write any. But on this playlist on the channel of mysteries, myths, and misconceptions around infinite banking, I wanted to have this conversation with you. So I'm just trying to build this up to let you begin to share some of your thoughts and experience about Index Universal Life. And you can give me the personal reflections that you have. You can give me the professional reflections that you have being in the space like we are.
Right.
So just dive in on whole life insurance, Index Universal, becoming your own banker, infinite banking, all of it.
Yeah, man, appreciate that conversation. It needs to be had in the space of life insurance, being that there are several different types of life insurance out there. We're dealing with that guaranteed stuff and whole life insurance just the way Nash would have talked about it in BYOB 5th edition. And what that means is we're not going to utilize infinite banking. We're not going to utilize the product of universal life insurance due to its volatile nature. Mm-hmm. And when we're talking to people about indexed universal life, most of the time, folks don't know what universal life is. So we're going to start extrapolating on what the possibilities could be, might be. We want them to be on index universal life, but do we know what universal life is? Because indexed universal life is just a variation
Today's
of the chassis,
flavor, right?
of the chassis of universal life. So there's so many things that can be said about it. I don't normally talk about it like this, but let's start with universal life. A lot of times when on my content with the Cash Compound, we're talking about this 3-cup setup format. And we'll stay off of that for 1 second. We'll go to universal life. Universal life insurance was invented around the time in the 1980s, early 1980s. So around 1980, when interest rates were super high. Mm-hmm. So life insurance, in terms of a long-term hold and preserving the buying power of dollars, was not attractive because interest rates were so high. So you could get a CD.
People are thinking returns.
Yes, you could get a CD, which is fine, totally fine. We're not to the idea of infinite banking yet. So, of course, we want to place our money in a place where we can place it in an environment, in a CD or in a bank account at that point in 1980 is able to outperform the buying power in whole life insurance. Well, then leave it in a bank account, right? I understand what they're thinking there. Mm-hmm. So universal life was created in that environment, first off. Well, interest rates have dropped steadily until now, 2024-ish. They've dropped for 40 years. So that's our lifetime. You and I, our lifetime, interest rates went from times before we were born down the whole time. So that is significant in the world.
Could we call that an artificially low interest rate environment?
Where it has dropped to?
Yeah. Well, just seeing that long going down trajectory.
You mean how high it was in the 80s? Is that what you're saying? That
no,
was
to the low part now. Would you have called it an artificially low up until here real recently? Would you have called it an
I
artificially
don't think
low?
that to be honest with you, I don't think I know enough about it
Fair
to
enough.
know
Okay.
to know if I would call it that or not. But so in the space of universal life insurance, the context of when it was created as a product prior to 1979 or something, it did not exist. Okay. So it was partially in response to the market at that time. Interest rates have been dropping since that time. So the universal life insurance chassis is a flexible contract, super flexible. And the flexibility comes in premium flexibility, death benefit flexibility. All these levers can be pulled on and messed with. Because of that, it's hard to know where in the world somebody might be in their policy. We don't actually know. You'd have to look at the performance. You'd have to look at how they have treated that policy and what they were.
I started to just go ahead and give you permission there. Speak in terms, if you want to, of Cup 1, 2, and 3, because that's an easy place for you to say, well, Cup 1, the premium amount that they're choosing to pay, human nature's probably going to step in, and they're going to pay less because they can pay less.
Right, and that doesn't mean everybody did. But in the cash compound environment, the team that I lead, we visualize this in the 3-cup setup. Cup 1 is premium. Cup 2 is cash value. Cup 3 is death benefit. So we're talking about life insurance, and the buckets are pools of money here, the cups. We've got premium, dollars we put in. That's the red cup, the first cup. That buys something from the insurance company. It's called death benefit when we're talking about life insurance. That's cup 3, the blue one. And then cash value is the equity so far in that death benefit. The death benefit is what's guaranteed to pay out today if you died.
Yeah.
Cash value is what's liquid so far today because there's equity. Because the insurance company at the time of whenever we're talking, day 1, day 100, day 1,000,000, this is what we'd pay today, death benefit, if you died today. Cash value is what we will give you now. You could borrow or loan against because there's equity in your policy. Okay, so that, if we're talking about whole life insurance, we are going to have the guaranteed death benefit stay with us for the entirety of life.
Yeah.
What I just explained to you in the 3-cup setup is still relevant to permanent life insurance or universal life. It's just we don't know if it's going to be there tomorrow. That's the rub. So at any given time, you still got the 3 cups going on here for universal life insurance, which is a form of permanent life insurance. The problem is with the word permanent is that's a misnomer because it may not be permanent tomorrow. In whole life insurance, it is. Okay, so I was trying to not commandeer the entire experience into the way we talk about it at the Cash Compound. I know
it's all good. You're making me want to go grab the cups for you anyway.
Oh, okay, then let's do it. So, ladies and gentlemen out there, when you were thinking about what's happening in terms of permanent life insurance, the death benefit cup number 3.
I'll even help you hold them so we can get them on screen.
The death benefit cup 3 may not be there tomorrow is the thing in universal life insurance. But in whole life insurance, it's guaranteed to be there until you die. You may die tomorrow, but you may die when you're 120 years old. It'll still be there. It's going to come out. We bought that pool of money from the insurance company with our premium dollars that we gave them. Okay, so here's the situation with universal life. With universal life insurance, the premiums are flexible. You can do different things with them. And if you do different things with them, that affects how much equity you're going to get, how much crediting you'll get in universal life, and how much death benefit is going to be there tomorrow. Well, that's a problem because another part of the chassis is it costs more every year to keep.
And I like you using that language of the chassis, the skeleton, the framework. So keep going right with that. You've mentioned the premiums are flexible, but what is that chassis?
The chassis is called yearly renewable term, YRT, or annual renewable term, ART. So what that means is not anything outside of the words themselves, 1, 2, 3. Ladies and gentlemen, annual renewable term, okay? So annual, each year. Renewable, it re-ups. And term insurance costs more each and every year because the insurance company realizes they're closer to your mortality. Mortality is when you die. So it's going to cost more each and every year for the insurance company to guarantee or carry the risk.
Mhm.
Okay, so I'm trying to use, especially, and if you know anything about Jdew on our stuff at the Cash Compound, we do it really simplified, and I'm trying to take it up a notch here because I know some of your listeners and learners are maybe a little more college level than some of mine, and we do it high school level. So I'm trying to actually use the real terms a little bit.
I appreciate your recognition of the audience.
Yeah, man. So what happens is, ladies and gentlemen, let me boil it all down. In universal life insurance, the cost of the policy goes up each and every year as you and I get closer to mortality or death.
Naturally.
Okay. Naturally. Okay. In whole life insurance, it is a fixed cost. So there is no annual renewable term or yearly renewable term. It stays at the same level.
Because the actuaries have already taken into account, okay, if we're going to take on the risk of this person for their whole life, this is what that's going to look like.
Right, and they have established the cost of that with the premium levels already up front. So they've
already mathed
this is what
the
it
math.
is. Yeah, the math has been mathed at that point. So what happens in universal life insurance is whether or not, and regardless of what type of crediting you might get in your cash value, the liquidity or equity of your policy, there's multiple types like variable universal, equity index universal, and just straight universal. What happens is the cost rises even if you did not pay more in premium. The cost is going to rise every year. So what happens is, in most cases, the cost becomes way too prohibitive for someone to keep the policy once they get into their elderly years.
So it's right at the time of life
when you needed
where
the money.
their passing is most likely, or when you would need all those important pieces.
Right. So why in the world would you try to buy something? Now, I understand if we go back to 1980, why our grandparents bought it, right? Our grandparents were 40 years old at that time. Seemed like the right deal. Super flexible. And so, boom.
The illustration would look beautiful.
Yes, the illustration would have looked great. But now our grandparents are now 80, right? So that was 40 years ago. So our grandparents are 80, 90 years old, and they're like, holy crap, they're still alive. This bad boy costs way too much to keep. All right? And if you did not properly fund it to its max, there's no chance. There is no chance it's going to make it because interest rates have been dropping. The guaranteed crediting and stock market has not performed, depending on where you had it, VULs and things like that. And policies started lapsing like 10 years after they were sold, and that was already 25 years ago. So these people got to a place where their age and their policy contract, and those two things betrayed them. And they're like, we can't keep this. I can't afford this. And if you end up in that space around the time that you are retiring, like where would you get the extra money?
Right.
To pay for it.
Because you just walked away from active income in a lot of cases.
Right. So your cash values, whether or not they were guaranteed crediting from UL or they were stock market returns, or starting in 1997, the index universal life chassis, which allowed you universal life insurance with an exposure to an index. Okay, so you start out with what in the world is universal life, then you add on, well, what does that mean? That means an index is your cash value does not get guaranteed crediting because in a lot of ULs there was a guaranteed crediting. They sent that guaranteed crediting over to the market and they bought options, 1-year call options, and the 1-year call options cost money.
Sure.
And maybe the index rose, maybe it didn't, maybe it stayed the same, and they let you potentially participate in some form of that. So what it is universal still with an index option of crediting. The problem is now, how much does that annual option cost? How much participation was I going to get in it? Are they going to change my participation year to year? And am I going to live long enough where it doesn't matter what my participation or the crediting was because the cost of the policy kept rising? So we don't know that in terms of longevity term yet because IULs were not invented till 97. They were not popular until 2009. And I have a sneaky suspicion they're not going to perform any better than whole life. And plenty of them are not going to perform well at all.
They certainly won't if they're not even still in existence.
Correct. And if you don't keep it, if you didn't fund it properly, if you didn't hold it long enough, there's no chance. I mean, options cost money.
So that's the second time you've said that, and it makes me think of the part in the Becoming Your Own Banker book where Nash talks about the customer pays for everything. And great. I mean, that's what makes the world go round, right? Is business and private contract and things like that. I love, but the fact that those options cost something is something that you've repeated, and that's just how I look at these things. Well, that cost is being passed on to the consumer, and it's already on top of the chassis of this annually renewing term, which is not the foundation that I would pick to build my banking life on. And that's where I, of course, want to be able to take everything back to is, so far you've given us an excellent synopsis and rundown of the product, but why are we even considering and having a discussion about these products of whole life and all these different types of universal and all these things? Is, well, we want to be our own banker. So if the chassis is this annually renewing term, which can certainly become prohibitive and all these other issues, and then you put these additional costs that, well, why would I want to assume that risk, and why would I want to assume that cost? I'm wanting to have something, I'm wanting to have something guaranteed that's going to grow and compound for me to be able to bank with. And I certainly don't want to get to that stage in life like you're talking about, my 60s, 70s, 80s, 90s, and beyond, because we are even more likely to live beyond. And folks that are listening to us that might be 20 years younger than you and I.
Sure.
They can be living even longer.
Yeah, but of course, it remains to be seen, right? And any individual person, we have no idea. You may die tomorrow. So good luck out there, everybody. Stay safe. But anyway,
guarantees, right? Like all the more reason for guarantees, period.
Right, but if you're hoping and planning to live a long life, you probably don't want to play the game on a universal life insurance policy chassis at all. And you may have hundreds of thousands of dollars stacked up in your equity value, your account value, surrender value, your cash value in universal life. But if it still starts eating away at that in your 70s and 80s, and you have a down year, some 0 years or 1% years of crediting, or potentially a 2% floor in your IUL, you're not going to make it. And if you live to 100, you're not going to make it, and you better not take any money out of it. Mm-hmm. So what good was that doing you? And if there is an alternative, because in a perfect storm scenario, I might want an IUL, maybe not for banking, but I'd use it less often than I use the whole life that I have. I may not want it for infinite banking to use regularly, like you and I personally use our policies. But I might want it for a retirement game long term because of other fees and surrender charges I didn't even get into in the early years. But I'm going to be really hesitant, and I'm going to have to monitor and watch it. But why would I do that when there is an alternative product with guarantees? Mm-hmm. Like, why would I take on that risk?
So before you move on then from that point of, so here's where I want you to, and use the cups, illustrate, where does the money come from when you get to that point to where there's still that cost of the annually renewing term, like the term self-cannibalizing is how I say it. Mm-hmm. The policy begins to self-cannibalize. Would you illustrate with your three-cup setup what self-cannibalization looks like with an IUL policy?
All right, ladies and gentlemen, we're coming to you with the three-cup setup. Premium dollars that you decide to put inside your system, your banking policies, your life insurance. You give them money. You pay premium. I do it too. And it buys something. That's cup 3. Death benefit. So as you can see, our pennies here in premium, cup 1, the red one, bought their dollars, right? Big money, no whammies. It's coming out. One day, your family, friends, church, and charities will get this benefit here at the end of your life. Now, cash value in whole life insurance is simple. It's the equity so far in the death benefit. And you can see that if you're watching this, I'm illustrating it with small, bigger, biggest. Over time, what happens is your guaranteed constant premium going in every month, every year, buys more and more death benefit. The types of policies we like to design and put together for infinite banking, the death benefit does rise. Cash value then is getting larger, and it just is more and more of the equity of that full gross benefit for later. This is the net now. In the event you die, both of these pools come to your family, friends, church, and charity. I'm simply illustrating cash value as how much of, you see where I pull the money from. I'm saying that out of your entire death benefit, the 2 cups that you've bought from the insurance company here, the equity so far in the gross, this is just how much equity or cash value you could get to. You die, it all comes out. It's one big pool. A lot of people out
windfall.
there, and a lot of people out there wrongly assume big time cash value is a separate pool, and the insurance company keeps it. Well, that's because you categorically not actually put cash value in the right place. That's not what it is. Cash value is the equity. It's not a separate pool. That's another pool that you get. No. It's the equity of the total pool. Okay, that big deal out there. And if that blew your mind right there.
Yeah, I'd have to think of which episode it is. It's in this playlist. It's in this Myths, Mysteries, and Misconceptions playlist where I've addressed that, and I appreciate you bringing it back up.
People have to.
There are so many
Dave Ramsey's out there telling
there's
people
the guy.
left and right. Susie Orman.
Those crooks, those scumbags, those dirtbags.
They steal, the insurance company steals your cash value. Then you didn't know what it was. Cash value was the equity value you had in the total. Think about your real estate. This is the equity. This is the total value. You sell your house. You don't get 2 pools of money. You get the total pool. The equity is gone. You sold the house. Right. Okay.
This is the net present day value of that future
some
greater
of you are going to get
benefit
it. Some
amount.
of you are not. I'm already letting you know. Okay. And you already figured it out. I don't know what they're talking about. They steal it. And I was like, well, we tried to tell you.
We did.
Okay. So now let's talk about these 3 cups in terms of an IUL, Index Universal Life Policy, or a Universal Life Policy, or a VUL policy. Okay. When you get, if you don't mind me looking at my hand here, this is the level of premium you keep paying. But the cost every year, annual annuitable term, continues to rise.
Right,
okay?
That's good.
So in the event that you live long enough, cost enough, that your cost is above your premium, 2 things, 3 things have to happen, basically. Okay, I can illustrate it right here. 1, you'd need to pay more out of your pocket.
Out of your pocket, out of your cash flows.
Because the cost was above the premium you were delivering to them. 2, cash value has to be eaten. The equity will automatically be cannibalizing itself into paying for the cost of the policy. Has to.
I mean, who wants that letter in their 60s, 70s, 80s saying, hey.
There's so many examples of it because there's so many old people in yesteryear used to call the news. Now you go on TikTok and Twitter and out somebody. But in the 90s and 2000s, when we were coming up, there's 80s and 90-year-olds calling the news and saying, the insurance companies are stealing from me. I've been paying faithfully into this thing, the number that's been on for 30 years. I've been paying my premium, whatever was on that paper, and now they're telling me it's about to lapse. I'm a month or 2, 3 months away from lapsing. I don't even understand. And that's because the cost rose above their premium. And the insurance company says, that's just what the contract said. Like, you can do whatever you want. You could have been flexible. You can pay more or whatever. But that's not what people thought was going on in their policy. So now they're 90 years old, realizing fixed income can't work. 90, they should be at Disney World putting their feet up and getting massages. And they're about to lose their death benefit, let alone the investment power and all this cash flow. No. They're going to lose their policy. So you pay more, 1 option. 2, it eats the cash value, so you don't have any. 3, your death benefit starts shrinking, goes away. That's what has to happen. That's how the contract is built. So all of that can be a combination of all that, right? Because it's flexible, so combination. You try to pay more to keep up with it. The market drops, tanks, goes backwards some. It starts eating cash value. It's now cannibalizing even the death benefit. It starts going down, goes away. You're doomed. You're done.
Yep. And I appreciate that breakdown on the product. And I think of 1 or 2 things that I think will bring this home to the average All-American that listens to this. That's great insight on the product right there. It matters what vehicle we pick. I'm certain with more than a dozen reasons of why the properly structured whole life policy with a mutual company that pays a dividend is the ideal financial asset. And all I got to do is go back to what problem are we going to try and solve with whatever product vehicle that we use? If the problem that we're wanting to solve is our need of finance now, and if that can go hand in hand with a big old whopping death benefit later on, beautiful, right? Because that's the problem, is that everything is financed, and people either pay credit for the things that they do or cash for the things that they do. So they're either beholden to the commercial banks to do what they want to do in life, or they're liquidating their hard-earned capital that they have built up and going back down to zero before they got to get the next car or pay for the next college education or the next child's wedding or whatever it happens to be, right? And what we're saying is the problem could be solved with the ideal product, but then furthermore, the paradigm can shift to, well, we become our own bankers. So I'm just saying these things align. The process of banking, that's not new.
Right.
Everything's finance. Banking exists.
I sure didn't understand it, but the process is about 10,000 years old.
Mm-hmm.
Yeah.
And then the ideal product that we can use, for us, we've arrived at whole life that's been structured this way that you described for that paradigm shift of becoming your own banker. So, I mean, that's my strongest encouragement is always going back to the book and what Nash said about universal life in general, his thoughts and feelings on it. I've lived that out. We've built a system of several policies for the banking purpose in our life, but we're looking ahead too.
You have to. Well, and that's the thing. So what Nelson Nash talks about and what we're realizing because of relative health, because of relative time and the dollars that we decide to fund our policies with, you and I both, is we're going to solve the banking equation. And if you solve the banking equation or the problem that you used to only bank and finance with a third party, it actually solves the problem of all the other things that people are talking about with universal life. If you solve the banking problem. Now, you're going to need to contribute significant dollars to your system to solve the banking problem. You're going to need to live longer than 5-10 years in most cases to solve the banking problem. Like, we need some time in there too. And you need to understand that you should use the policy for financing purchases. But if you get those things, you can solve the banking equation. A lot of people out there with IULs, as well as many other investment tools, are trying to solve a nest egg or a cash flow issue only. But when they don't solve the banking problem, you have to ask yourself different questions because they're not solving the banking equation at all. And it took me, I would say that it took me probably 4 to 6 years of doing this to quite be able to understand and then eventually with the cash compound articulate the banking problem. I couldn't articulate it. I knew that the dollars were going up and they were guaranteed in cash flowing, but I didn't quite understand actually the banking problem. And so when people say, hey, you want a rich man's Roth, right? This is the 21st century way to do insurance. This is the way to cut back on the government's fees and your nest egg problems with your, they're not saying anything about the banking problem, which is now that's part of our mission, both of us. If you help people understand what that problem is, then they realize that the product or the process or the tool that they were using, oh, that's not solving the banking problem. And if I solve the banking problem, everything else gets fixed.
We're in a neat space for sure, because you do have these folks online nowadays who are talking IUL over here. And then you got the folks out there like the Dave Ramsey that people are very aware of what they say, by term, invest the difference. And then on the Dave Ramsey side, he and his personalities on his show, and I'm just saying it just is what it is. This is what they say. They'll still tell you, yeah, well, have that money market account, have those 3 to 6 months in a bank.
You're right.
And yeah, I'm tracking what you're saying.
And so it's like, I'd like to meet a lot of these personalities. I think we'd get along if we weren't talking about life insurance. We'd get along quite well. They're doing a lot of things in terms of kingdom work. I'm a Christian, as well as, of course, consumerism. Right? They fight that with a lot of things they're talking about.
And they're inspirational as business owners.
They're inspirational. They've done so much good in business, helping tons of people, but it's just skipping over
the banking function.
And
that's what I was trying to say.
It took me so long to even understand it while I was practicing. They jump over banking, and they say, well, you're going to save your money in XYZ or place your money in these investment products. And I go, oh, they're not talking about banking.
They're not even talking about it.
Yeah, and for those of us who catch on to that banking conversation, equation, problem to be solved, and realize this product's assets and features, you're like, oh, I'm putting my money right here.
That's what I'm talking about. Listen, I really appreciate you letting me pull you in here at the end of a long day of phone calls and meetings and everything else. But I knew that this is a subject that I wanted to get to. And with us being in the office today, I wanted to grab you in on it. So I appreciate you sharing your experience with us.
Glad to be a part of it, man.
I love it. Seriously, thank you. All right, that was an absolute pleasure for me. I hope you got a lot of value out of that conversation. If you'd like to carry this conversation on and have a one-on-one consultation about what it could look like for you to implement the infinite banking concept into your household or your business or your investing, then don't hesitate to check out my free introductory presentation and jump on my calendar link at durhamtalents.com. I hope you have a great day. We'll talk soon. Take care.